Hey everyone, Brian Bogner, Greg Towner here with Parallel Portfolios, and we're going to do something a little different this month. We are going to start a monthly long form discussion on what we're seeing in the markets right now, what's going on. I guess you could call this kind of a podcast type format, but instead of our, short 5-minute presentation type videos, this will be a little bit longer. You can play it in your car while you're driving. You don't have to watch our ugly mugs. You can just listen to it. But we're going to be talking about things that we're thinking about in terms of how we view the economy, how we view the market. And today, our topic is going to be about this thing that everyone's talking about is, are we in a recession? Is a recession happening? Is it upcoming? Is something coming up that we don't know about? So our goal is to try to keep this maybe around 15 minutes, somewhere in that range. This is our first one we're doing. So, enjoy the ride with us. You'll see how it goes. So how are things going with you, Greg?
Well, things are great. I'm really excited about the new format, allowing us to dig deeper on a topic, obviously focus on a lot that affects our investment world, but even go off topic a little bit from time to time and cover some other areas of interest.
Yeah. Well, let's start there. Anytime that I talk with another, whether with a client or with an advisor, another advisor or something like that, I'm always asking them, like, what do you, we read so much data, right? We read so many reports and analytic reports and things like that. And sometimes it's just good to know, what are you seeing? Like, who are you talking to? What's happening in your neck of the woods around you? So what are you seeing? And for those of you that don't know, Greg lives in Raleigh, North Carolina. Of course, we're headquartered here in Greenville, South Carolina. So a lot of times I like to, Raleigh's a hot spot right now, a lot happening there. So what's been happening in your neck of the woods?
Yeah, absolutely. Growth here, like in Greenville, is exploding still very strong, as a lot of, growing cities are in the South. But you're right. I know you speak with a lot of business owners and a lot of contacts to kind of get a feel for what's happening out there. And I had opportunity to speak recently with a neighbor of ours. He's a restaurant owner here locally, has been for quite a while, and it's just kind of picking his brain to see what is going on. And for the longest time, even pre-COVID, he talked about one of his biggest challenges, definitely his biggest challenge, was staffing. And of course, now he's also dealing with food inflation and everything else that everybody is well aware of. But he said his business is still going well. Restaurant business is fine for him. Maybe slow down a hair, but not much. But he said even still, this biggest challenge for him is finding qualified workers. He, and I know historically, I don't know exactly what he pays, but he's always said he pays above market wages, and he's a good guy. I think he'd be a pretty good guy to work for, but he still is finding difficulty finding appropriate workers. And I think we're going to expand on that as we go along in our conversation today.
Well, good. That's awesome.
What about you? What are you seeing out there? I know you've been on the road a fair amount for business and otherwise.
Yeah. Been on the road some, both business and personal. I think, like a lot of folks, there's been a lot of travel that's been pent up, and this summer there's a lot of people traveling, and I've certainly been no different. Of course, we've read about it in the news, and I have experienced it firsthand, of flight cancellations and all kinds of stuff. It's not fun flying commercial right now, I can tell you that. But one of my recent flights, I was in Boston, and we were flying, let's see, Boston, LaGuardia back to Greenville. And but I was in Boston, and and the crew of the flight was there, and of course we were waiting. And so I just struck up a conversation with a pilot, and I was just asking him, like, how y'all doing? What's going on? And he was telling me that they've already amassed more overtime this year than 2018 and 19 combined. This is just Delta. So, to give you an idea of how overworked these folks are right now. But the interesting thing he said to me was that I guess these pilots have an hourly limit in terms of what they can fly a year for that airline. And it's, I don't know, I think if I remember correctly, it was like 1,000 hours or something like that. But he said, like, he'll hit that in the middle of November. And he says all these other pilots, they're with him, are on the same track to hit there. So he's like, we're scratching our head wondering, for the Thanksgiving and holiday season, what in this case, he was talking about Delta there, but it's like, what are they going to do when these pilots hit that? If they hit that limit, they can't fly anymore. He's like, I'm going to get a 6-week vacation, basically. So I thought that was interesting. And it made me think, like, well, maybe maybe this holiday season we stay close to home this year. I don't know. But there's certainly a lot of activity. I mean, I took a trip out to the West Coast, took a trip to the Northeast. I've been out west a couple times actually, and even just in my own backyard here in Greenville. It doesn't matter where I go, doesn't matter. I mean, everything seems to be full, right?
Right.
Packed out, and whether it's a weeknight, a weekend night, you walk into a restaurant, you walk down the street, just there just seems to be this big buzz of economic activity, and it's interesting right now because you've got, I talk to people and even you look at all the sentiment numbers and everybody's worried and scared and inflation is a big issue, but yet we're kind of seeing on the other side, there's still a lot of people spent, there's still a lot of money getting spent. There's still a lot of things happening. And, and I know one thing I think of a lot is this just stuff that was just pent up, for these past couple of years, it's now getting is now getting spent. And, at the end of the summer or whatever, is that going to dry up or not? I don't know. But that was just something that's been on my mind a lot.
Yeah, absolutely. I think there's no question. We've seen some shifting spending habits, right? I mean, everybody was one way or another focusing on spending on things, their home. When they were locked down in COVID, they were
Right.
spending on their home and all of that. And now they're spending more on going out and experiences and travel. And so people are still spending, they're just doing it in different ways. And that's affecting a lot of things, of course.
Right. Right. Well, let's get on this topic of recession.
Yeah.
You know, let's define what a recession is. I think a lot of people, when we think of recession, I know I do this sometimes. I know people do it. We revert back to 2008 and think, oh my gosh, that means, half the people are going to lose their jobs and the market's going to crash and everyone's going to crash and it's going to be horrible for a while. But what exactly is a recession?
Yeah, I think a lot of people somehow have kind of adopted the methodology of, well, it's 2 consecutive quarters of negative GDP. You kind of hear that thrown out there in the media and so forth, and you're starting to hear it now because it's possible that is what we're going to have happen right now. But the reality is that has not really been used much in the past.
Mhm.
The National Bureau of Economic Research, NBER, they're the ones that actually designate what a recession is. And they look at a wide variety of indicators, manufacturing output, income levels. Most importantly, they look at employment, and we're going to talk more about that. But there's definitely been times in the past where you had, 2 negative GDPs and they didn't declare a recession, and then other times where they declared a recession and we didn't have 2 negative GDPs. So it's really a period where activity is reduced, people are losing jobs. It doesn't have to be a huge calamity like the Great Financial Crisis. Like you said, people tend to revert back to that difficult period. And
Right.
no scenario, of course, can be ruled out. But recessions can also be mild, where a large part of the workforce and people really don't even know what's going on if they didn't, see it in the headlines. Obviously, what's the old quote? A recession is when you lose your job, and a depression, or a recession is when your neighbor loses their job, and a depression is when you lose your job, right?
Yeah.
So it's a recession can happen and you don't even really know it, or it can be just the worst case scenario. So it's a wide spectrum of things.
Well, let's talk about the job front because, as we've seen, and, it seems like right now companies that are announcing layoffs and things like that, are like what I like to call these marginal companies. I mean, these are the
Right.
ones that were kind of on the front edge of a lot of the speculative activity in this last big boom cycle, right? Whether
Right.
it was, cryptocurrency or something that, was kind of new or whatever, you're seeing job losses there. But I think we've yet to see job losses, what I like to call the main street industries and things like that at this point.
I agree. I mean, those layoffs that we're seeing, definitely attention grabbing, just because the media wants to put them out there. And they're notable companies in the sense that a lot of people are familiar with them or have become familiar in the last couple of years. But we had a big monthly jobs report data this past Friday. We actually added a lot more jobs than even the
Mhm.
economists had expected. So we're adding jobs. We're not decreasing jobs. In fact, I saw that there's still twice as many job openings as there are unemployed people. So the job market is still very strong. I mean, maybe on the margin, it's weakening a little bit, like you referred to. I mean, but you're coming off of, arguably early this year, it was the strongest job market in history.
Right.
And so you're kind of coming off this incredible level.
Right.
And, I think it's inevitable it's going to worsen some. I mean, frankly, the Fed, which we'll get into more, is trying to worsen it, oddly enough. But, what I've seen is from corporations, they don't want to lay people off. They're pretty reluctant to, because, by and large, they're still seeing business solid. They just spent a lot of time, and money
Mm-hmm.
hiring and training people. They know how hard it is to find good people. So they really don't want to lay people off. But in the back of my mind, I also remember from, economics classes, employment and jobs are kind of coincident with the economy. They're not necessarily
Right.
leading indicators. So
Right.
things can get worse there when the economy's already turned. So it's not at all clear, but it's still a good sign that the job situation is strong.
Yeah. Yeah. Yeah, I mean, even again, and I know this is anecdotal, but just a lot of the small business owners that I speak with, just here, in the upstate and Greenville and around this area, I mean, pretty much all of them are they're rocking and rolling and saying, look, we're doing well, and we're just trying to find good people to
Yeah.
to do the work, and that's really the biggest challenge. So, supply chain issues is usually their issue. Um, and that's been an issue now for a while, trying to get the goods and the raw materials and the things that they need. Hopefully that's starting to ease up a little bit, but then finding good people there. So you mentioned
Yeah.
the Fed. We know that they're raising rates right now, and I think a lot of people get confused when they think the Fed's raising rates. And I try to explain them. There's a yield curve, right? There's the short end, and then you have the long end, and all the Fed really controls is that short end in terms of when we hear about the Fed funds rate. And then there's this thing called quantitative easing where they try to manipulate the long end as well, and it gets very
Right.
confusing at
Yeah.
times. But essentially, what they're doing is they're tightening, right,
Hmm.
on the short end, and they're also starting to tighten on the long end. All those bonds, those longer bonds that they bought all these past years, they're starting to let roll off their balance sheet now, which again, right, if you have more supply and less demand, right, then it's going to bring prices down, which, prices and bonds are inverse of each other, right? So as prices come down, rates go up. And I know that can be very, very, very confusing. Maybe we need a video just explaining how that process works. But the whole idea is that Fed action right now is creating a headwind by increasing the cost of funds. Because when you can get easy money and access to easy money, you can buy something, you can do that deal, you can purchase that whatever, you can invest in whatever you can get that money cheap, and then you can invest in it. And you can say, well, if my cost of funds is 3% and I earn 5% on this deal, then I can make money, or at worst break even, and da 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 da. And it's a very low threshold. Well, as your cost of funds go up, now you've got to earn a much higher return on those investments and things like that to justify the borrowing. So you really are tightening things out there. What are you seeing in that regard?
Yeah, I mean, the Fed's in a tough spot right here. Admittedly, some of it to their own doing. They took a while to take action, but I mean, they're hoping for the proverbial soft landing, right, where they can
Right.
raise rates enough to bring down inflation. That's their whole goal, is to bring down inflation.
Right.
But to do that without putting the economy into recession. And that's tough. I mean, it's difficult to do. In fact, you look at their language, they openly admit that, hey, we may have to cause some sort of minor recession to bring inflation down enough, because of course they can't help the supply side. They can't go out there and produce more oil or produce more, copper or what have you, but they can reduce demand to some extent by the process that you just explained, by raising rates and removing liquidity. So that's their goal. And I think that's, we'll talk a little bit more about the market in a minute, but that's, part of the market's concern is, can they land this properly? And that's a big question mark that we're all waiting to see.
Do you think inflation has peaked? Do you think we still have a lot more to see? What are your thoughts there?
That's a great question. I mean, we're going to have a big CPI number here coming up this week. I
Mhm.
think that will be notable, but I think people are starting to look ahead a little bit already and say, look at all the commodity prices that have come down. I mean, we're starting to see gasoline come down a little bit, not huge, but a modest amount. But people may not be aware how much other commodities have come down, copper and some of the agricultural
Right.
areas,
Right.
steel, all of that's come down a lot. If you haven't seen it already, you're going to see some great back to school shopping at Target and Walmart and those sorts of places. Their inventory, they really
Right.
overdid their inventory. The supply chains, I don't want to call them fixed, but they're improving for sure. So all these things combined should definitely be helping inflation, whether it's peaked or not. I think we're in that ballpark. That's certainly what the Fed's trying to do. One thing working against inflation, back to we talked about the strong job market. If
Right.
people have jobs, what are they going to do? They're
Spend
going to
money.
spend, right? so, so as long as they're spending and their wages are going up, that's going to be counteracting against some of those others. So my best guess is we're at or near the point where inflation has peaked, but
Right.
that doesn't mean it's going to roll over and it's just going to be feeling a little bit better.
Yeah, exactly. Exactly. Okay. Well, that's good. I agree. I agree. I think we are at, or it has peaked, or I think we've seen the worst and worst of it. And now just if and how it recovers, I think it remains to be seen. Um, why don't we go ahead and talk a little bit about stocks, because at the end of the day, we can talk about recession, we can talk about these things, but we've got money invested in the markets here. So how does it affect, these things that we're talking about? You know, we talk about stocks are always being, and I think it's important to remember stocks are forward looking
Right.
and economic numbers are backward looking, right? So when you get that CPI number or that GDP number, whatever, it's reporting on what has happened. Well, stocks is an active market where you have buyers and sellers coming together, and it's always looking out 6 months ahead, 12 months ahead, things like that. So if we're in a recession or a recession's coming, you can somewhat make the case that the market has already taken that into account, or it's already discounted in the price. Now, we don't know for sure, right?
Sure.
But the market's down 20 whatever percent, which, typically, right, historically that's a bear market.
Right.
And that defines what a recession is. Well, what are some of your thoughts?
Yeah, I mean, there's no question. You're right that the market it started factoring in months ago this whole challenge that we just talked about with the Fed. Are they going to have to put things into a recession to fix inflation? I think with the market down about that 20+%, some areas much worse. If we're able to avoid a recession or even have a minor recession, we're probably already factored in most, if not even potentially all of the stock damage. The more difficult period becomes if we get it like a real recession, something that lasts, multiple quarters or even into years. That's where it gets to be more difficult for the stock market. But I
Hmm.
think, maybe even above and beyond that is some of the things that we've been looking at is I think investors have gotten used to the whole V recovery, right? The market
Right.
comes down and just rebounds right straight back up. Obviously, the textbook case was the COVID lows in March 2020. And there's been some others recently as well. But a lot of that, why did that happen? When things got bad, the Fed stepped in with liquidity, right? And they provided liquidity. Well, of course, they're doing the opposite now. So they're working against us now. I guess you could argue, hey, maybe they'll back off a little bit from their
Mhm.
tightening, and that will be the so-called easing. That may or may not be. But I think we're of the view that, and we're already seeing it. The market's had a couple of rally attempts. The V failed. I think it's going to need more of a basing pattern, as we say in the technical world, and
Right.
that doesn't mean just decline amount, but it means time period,
Right.
and that's fine. We've seen a lot of rotation within the market, creates opportunities, creates risks. So I
Right.
think that basing period is probably good over the longer term, rather than just immediately go back to new highs.
Right. But the challenge becomes, I mean, obviously we talk about our investment process, QRLT and risk management and things like that. And I think some people say, well, let's go raise a bunch of cash here.
Mm,
And you got to be
yeah,
careful of that, because um, we do have some cash in a lot of our portfolios right now, and
right,
and whatnot. But this idea of trying to time, like, well, let's get all in cash. When even in a basing pattern, V pattern, whatever you want, but when the market decides it wants to go, most of those gains are in the early stages. If,
right.
if you look historically, it's not like the market decides it's just going to go and then it just takes its time. Usually you get these big early moves up, and then it kind of starts to, slow down and move higher. And you've missed out on a significant amount of gain at that point. And now you're trying to put that money back in and you're chasing it. And that's not always a best thing either.
Yeah, and
So yeah,
when that market's making those big gains, what does the world feel like at that point? It still feels terrible, right?
right, exactly.
It's not, when you get
Yeah,
the all clear signal that the world is good again, well, the market's already long factored that in. So when people have gone to cash because they were, worried
right.
about things, waiting for better days, they're going to miss those returns. Now don't get me wrong. Like you said, we hold some cash. We are big believers in
Right.
utilizing cash and risk management, but not in an all in or all out strategy.
No,
It's just in a matter of risk management. It's trying to smooth the volatility a little bit.
exactly. You're exactly right. Like it's yeah, I couldn't have said it better. And again, in this recovery, like you said, there's going to be some headwind from the Fed. I mean, we're in a tightening environment right now, and so it's not the what we've seen over the last 10 years, where it's been all this tailwind and liquidity and easy money and easy money and easy money. It's like those days are gone, and
Right.
so it is going to take. I like to say it's probably going to be a little bit of a slog,
Right.
and I would just caution folks when they think, well, after the election, people like to put these arbitrary things in. Well, when the election happens, or they'll say, well, when this happens, then I want to invest, or when this happens, or when that happens. And very
Right.
rarely does it ever work out that way. Because to your point, it's usually some of the best times is when it feels the worst.
Yeah.
And when it feels good to invest, you've already missed a good part of the move there. So I think that's a really, really good word. Well, hey, we're kind of getting here, encroaching. I think we've gone past our fit. This, by the way, is our first time we've done this. We're past our 15 minutes here that we were hoping for, and we're pushing 20. So why don't we go ahead and maybe start wrapping this up a little bit? But I would like to. I know we didn't really have this on the agenda, but I know a lot of people talk about it. But maybe we just take a minute here and give our thoughts on housing, because I know it affects so much of us, and there's a lot happening there. You got any thoughts there?
Yeah, I do actually. I follow housing quite closely, just as obviously for our business related, but also just it's an area of interest as a hobby almost. And I think you're starting to see some softening, particularly in those hotter markets. I saw some
Right.
data like out of Austin, for example.
Right.
A super hot market that inventory is really jumping. You saw interest rates, mortgages go up over 6%. Now they've come back down already to 5.5 or so. I've seen some anecdotal things around here in Raleigh where things are still hot, but maybe softening a little bit. I think that the demand side is definitely getting hit with that increase in interest rates.
Mm-hmm.
But unlike back in the financial crisis, we don't have this huge, push of supply. There's not
Right.
just this massive supply of homes being sold. So it's going to keep the market pretty tight, in my opinion. Now, prices are high. There's no question there's some room for things to soften. But unless you have a big flood of supply, it's hard to see housing be the big problem than it was last time. People always worry about what the last,
Right.
crisis was, but it's
Right.
usually something different. And
Right.
so, it's definitely something to keep in mind. But rents, apartment rents are still high, and that's we talked about inflation. That's a factor in
Right.
inflation as well.
Right.
Yeah.
Yeah, I think. Yeah, I agree. I think it's a good way to look at it. It's softening, but again, just be careful not to go back to what your last experience was in '08 and say, well, then we're on the verge of a housing crash. That's probably not likely.
Right.
What we always want, whether it's housing or whatever, we want good, steady growth. And a lot of times, even when you get extended from that, which I believe housing has, you can revert back to the mean, but the mean is still an upward moving average there. So,
Right.
but yeah, I'd say it's probably gotten a little bit extended, and it is coming back, but it's slowly and kind of taking its time coming back there.
Yeah.
Well, good. Well, as we close this out, let's yeah, what yeah, let's close this out maybe with some, kind of what can you do with all this knowledge here? What's some good takeaways and action items and things like that? Do you want to go first?
Yeah. Yeah. I'll go first. I have one on the investment side, a real takeaway from the
Okay.
business aspect of it. And then I got one more fun kind of, I don't know, we'll call it pop culture type thing to keep it a little
Nice.
more interesting. But no, I think right now with everything that's going on in the market, the volatility in the market, the volatility in the economy, now is a good time to evaluate your appropriate asset allocation with your advisor. Not to make a change based solely on the market action and try to time things, but
Hmm.
literally, do you need to make a change because of a different, level of you're at a different point in your life now, perhaps than the last time you evaluated it. Maybe you can't handle the volatility as well as you used to, or something has changed in your life. So now's a good time to look at your asset allocation and say, is this, what I needed 10 years ago? Is it still the appropriate thing now? So kind of revisit that during a period like this and see if you need to make any change, is my view on the investment recommendation.
Good word.
And then more on the fun side. So I'm a big Tour de France cycling fan. I love to watch it on television, but not many people here in the States watch it. It's on USA Network. It's about halfway through right now. We had something fun this weekend. Friends of ours visited. They had no idea about the tour, but every time we have people come visit us in July, they just get enthralled by it. We explained it all to them. The scenery through the countryside and mountains of France is incredible. They just are so into it. They ask so many questions. It just made me think, I think a lot of people are missing out because they're maybe not into cycling or they don't know anything about it. You don't have to know much to enjoy the scenery, to learn about the teamwork and all the strategy involved. This Thursday is the most iconic mountain stage, Alpe d'Huez stage. So if you're going to watch one stage, watch this Thursday, USA Network. You can record it and watch it over the weekend or what have you, but give it a try. It's a lot of fun. Tour de France.
Awesome. Good recommendation. Well, I'll do my fun recommendation then along those lines. I have been just addicted, I guess, to the Netflix documentary on the Formula One racing.
Oh, yeah.
And I've been a big NASCAR fan for a lot of years and just kind of I've watched Formula One from afar, and I started watching that. And I got to tell you, it has been just fascinating to watch the way the teams operate, the challenges. I mean, they travel all over the world, these different tracks, it's streets, it's just so much different things that they got to deal with. And, in NASCAR, they kind of go one direction around the loop, which is hard, but these guys are driving all over the place. And if they hit another car, they could just be done for the race. And there's so much high stakes going on, and every little, I mean, even from just the guy bolting on the tire, every little thing can make such a huge impact and difference. And I've really been enjoying it there. But bringing it back here and just kind of closing this out in terms of, my recommendation on the investment side is I would say that, we have been blessed, since the lows of 2009. So the last 12, 13 years of just an unbelievable up bull market. And like we just been talking about, it's been fed by the Fed, a lot of easy money, liquidity, things like that. And like you say, when the market went down, you just buy it and go right back up. And we believe those days are gone. That's done. And so, over the last 12, 13 years, just owning an index, you'd have been fine because those things, everything was going up. Now, some things are going up a lot more than others, but everything was going up. And that's not the case anymore. So the case now is there are things going down. I mean, just take this year to date, for example. I mean, energy's up, like 50% year to date, and you've got other sectors that are down like 30%. I mean, that's a massive, massive difference there of just, these are just large cap stocks in the S&P 500. Right. So there has been a change. Passive management, where you just buy an index, has worked. We don't believe it's going to be working necessarily in your favor here over the next 10 years. Having active management, being able to analyze the market, use risk management, buying high quality, and being able to move through these things with this slog that we have ahead of us, we truly believe is the best strategy right now. So we'll go ahead and wrap it up there. If you have any questions, you know how to reach us here at Parallel. But we thank you so much for listening to our inaugural first ever long form show. And if you have any advice or comments or critique or anything, we're certainly welcome to it. But thanks so much for watching.
Thank you.